It's easy to make money in crypto, right? But keeping those gains, that's the hard part. The crypto market is designed to tempt you and trick you into making mistakes. Mistakes that could turn 100 times gain into a total loss literally overnight. I've seen it happen time and time again. People get caught up in the hype, make emotional decisions, and end up losing everything. Today, I'll walk you through the 10 biggest mistakes people make in crypto and what can do instead to secure life-changing gains. If you're holding crypto or even about it, this is the video you need to watch all the way through. First up, picking the wrong crypto exchange. Using the wrong exchange can cost you big time with high fees, limited crypto options, and outages during critical trading times. Can you imagine missing out on a massive pump because your exchange crashed? Nightmare fuel. So, what should you do? Don't just blindly jump into the first exchange you see. The largest and most popular exchanges often come with the highest fees. Smaller exchanges might have lower fees but lack the support for all the cryptos you're interested in. That's why it's crucial to choose an exchange that aligns with your specific needs. Do you prioritize low fees, a vast selection of altcoins, or maybe a user-friendly interface? Figure out what matters most to you and choose accordingly. Need a little help deciding? Check out my recent video on the top 5 crypto exchanges. I'll drop a link in the description below. It breaks down everything you need to know to make the right choice. Remember, a little bit of research goes a long way. Ever watched your crypto skyrocket, hitting a new all-time high only to see it come crashing back down? It's called round tripping. When the price is pumping, it's tough to sell. You get hit with FOMO, the fear of missing out. But here's the thing, you only actually make money when you sell. The secret to avoiding this mistake? Set profit targets you even buy. Decide how much profit you'd be happy with, and when your crypto hits that target, sell. It doesn't have to be all at once. You can scale out gradually. Managing your emotions is just as important as managing your money in the crypto market. Raise your hand if you've ever seen a coin pumping like crazy and felt that irresistible urge to jump in, thinking you're missing out on the next Bitcoin. It's that FOMO monster rearing its ugly head again. But here's the harsh truth. Most of these parabolic pumps are driven by hype, manipulation, and bots. And by the time you hear about it and get in, it's often too late. The whales who pumped it up are already dumping their bags, leaving you with losses. So, how do you avoid becoming another FOMO victim? Stop chasing pumps. Instead of reacting emotionally to every green candle, focus on doing your research and finding solid projects they pump. Look for cryptos in related niches that haven't surged yet. Anticipate the next move. Overtrading. It's the kryptonite of many crypto investors. You see your portfolio lagging, you panic, and then you start selling perfectly good coins to chase the latest pump, only to watch those crash right after. It's a vicious cycle that can drain your funds faster than you can say Satoshi. The problem with overtrading is that it's driven by emotion, not logic. You're constantly second-guessing yourself, making impulsive decisions based on fear and greed. So what's the solution? Stop trying to time the market perfectly. Either invest the time and energy to learn proper trading strategies, or stick to a more passive, long-term approach. Remember, slow and steady wins the race. High leverage, don't get liquidated, leverage. It's the double-edged sword of the crypto world. It can amplify your gains, turning a 10% gain into a 100% gain. But it can also wipe you out faster than you can say margin call. A 10% drop with 10 times leverage? Yeah, that's a total liquidation of your position. Leverage is not inherently bad. It can be a powerful tool for experienced traders who know how to manage risk. But for beginners or those with a low risk tolerance, it's a recipe for disaster. If you're new to crypto or trading in general, steer clear of leverage. Focus on learning the ropes, building your portfolio, and understanding how the market works before even thinking about leverage. If you do decide to trade with leverage, always use stop losses. It's like an insurance policy for your trades. Not self-custodying, control your crypto. Keeping all your crypto on exchanges is like storing all your cash in someone else's wallet. Exchanges are centralized entities, which means they're vulnerable to hacks, insolvencies, and even government shutdowns. And if something happens to the exchange, your crypto could be gone forever. So, what's the solution? Self-custody. It means taking control of your crypto and storing it yourself, usually with a hardware wallet. Think of a hardware wallet like a physical vault for your digital gold. It's a small, offline device that stores your private keys, the keys that give you access to your crypto completely offline. This makes it virtually impossible for hackers to steal your crypto. There are tons of user-friendly options available these days, like the Ledger Nano and Trezor, that make self-custody a breeze. If you're holding a newer crypto that's not yet supported by hardware wallets, stick to its official software wallet. It's still better than leaving your crypto on an exchange. Blindly following influencers, think for yourself. Not all crypto influencers have your best interests at heart. Many are paid handsomely to promote projects, often without disclosing their financial ties. They'll shill you anything to pump their bags, regardless of whether it's a good investment or not. So, what's the solution? Do your own research. Don't blindly follow anyone in the crypto space, no matter how popular or trustworthy they seem. Question everything. Read the project's white paper, understand its technology, and assess its team. Look for red flags like anonymous founders, unrealistic promises, or a lack of transparency. Stay critical, stay informed, and think for yourself. Diversification. It's a word thrown around a lot in the investment world, and for good reason. But when it comes to crypto, there's a sweet spot. Having all your money in one coin? Super risky. One market crash, one hack, one regulatory change, and boom, your entire investment could be wiped out. But spreading your money across hundreds of different cryptos? That's not ideal either. It's inefficient, difficult to track, and you might miss out on substantial gains by diluting your investment too much. So, what's the sweet spot? Diversifying into a handful of strong, well-researched cryptos across different niches. This approach helps balance risk and reward while keeping your portfolio manageable. Think of it as building a balanced crypto portfolio. The crypto world is like the Wild West, exciting, full of opportunity, but also teeming with scammers and hackers. One wrong click, one careless mistake, and your hard-earned crypto could be gone in the blink of an eye. So, how do you protect yourself in this digital frontier? By practicing good crypto hygiene. First and foremost, always double-check URLs. Scammers are masters of creating fake websites that look identical to legitimate ones. Always double-check the URL, look for the padlock icon in the address bar, and be wary of any suspicious links. Next up, enable two-factor authentication, 2FA, on all your accounts. It requires you to enter a unique code from your phone or email in addition to your password when logging in. And finally, never ever share your private keys with anyone. Legitimate companies and services will never ask for your private keys, so if someone asks for them, it's a scam. Look, we all know crypto is volatile. It's a wild ride with massive upswings and gut-wrenching downswings, and if you don't have a plan, you're setting yourself up for disaster. You'll be driven by emotion, making impulsive decisions based on fear and greed. So before you even think about buying your first Satoshi, sit down and create a solid crypto plan. It doesn't have to be complicated, but it needs to outline your goals, your risk tolerance, and your strategy. Start by defining your goals. Why are you investing in crypto? Are you looking to make a quick profit, or are you in it for the long haul? Next, determine your risk tolerance. How much are you willing to lose? Finally, outline your strategy. When will you buy? When will you sell? What criteria will you use to make those decisions? Remember, failing to plan is planning to fail. And there you have it, the 10 biggest crypto mistakes and, more importantly, how to avoid them. The key is to educate yourself, stay vigilant, and never stop learning. Which mistake have you made before? Let me know in the comments below, and let's learn from each other's experiences. If you found this video helpful, hit that like button, subscribe to the channel if you haven't already, and ring that notification bell so you never miss another tip. Thanks for watching, and I'll see you in the next one.